Stocks rallying again today with tech as a big winner. The Nasdaq surging almost 2%, but the market's biggest bear is telling clients to double down on getting defensive. Mike Wilson is Morgan Stanley's chief U.S. equity strategist and CIO. Mike, always great to see you.
Thanks for having me.
You say the recent bounce we've seen, that was technical. You could have called it. You called it. But that's over. Why is that over?
Well, we think it's over. We don't know for sure, obviously. But, it does have all the hallmarks of what I would call a bear market rally. We expected a bear market rally at the time, that things got oversold. It probably went a little further, quite frankly, than we would have thought, particularly in the S&P 500. But the Nasdaq's right into resistance again here, kind of throwing back into the 200-day moving average. So from a purely technical standpoint, that's what it looks like to me. So that's how we're calling it. But more importantly, Melissa, I would say the reason we think, it's a good time to remain defensive is because, look, we're late cycle. We've written a lot about this. We think we're later cycle than perhaps some people think, although everybody's talking about an inverted yield curve. We don't think there's a recession this year, but maybe next year there could be one. And so the markets are going to trade defensively. So you can still make money in this market, but what it really means is you got to pay up for earning stability, achievability, operational efficiency, kind of these boring metrics that tend to work at this stage of the economic expansion.
Hey, Mike, is that mega cap tech, in your opinion, when you think about the monopolies, the recurring revenue that all of them are increasingly have, just the moats and the balance sheets. And so that's the one thing. It's funny. I struggle with it. You hear me. You and I have talked about it on this show before. Sometimes I feel like they're defensive because we know those top four names make up a little more than 20% of the S&P and nearly 40% of the Nasdaq 100. And if they don't give it up, then the markets are not going anywhere.
That's exactly right. Some of those stocks for sure are defensively oriented and they're very high quality, terrific balance sheets, cash flow generators. But even within that group, Dan, we've seen some separation of the, truly defensively oriented ones and the ones that maybe were pretenders. And, I think it remains to be seen. You've been around the tech block a long time. You and I've talked for 30 years almost, seems like. But my guess is that many of these stocks are going to prove to be more cyclical than what people anticipate this year. Because of the nature of the COVID, recession, the work from home, the pull forward in demand that we saw in a lot of these tech wares may prove to be a bit more cyclical this year. So that's the risk. That's why we're not as bullish on tech as some others. We're neutral on the group. But we think that the defensive qualities that we seek can be better found in areas like healthcare, maybe even utilities and staples and REITs.
Is there one factor, Mike, that you could see as being reason to revisit your thinking on how much further we go down? Would it be a resolution of Ukraine-Russia, for instance? Or, what would that be?
Well, I think it could be a lot of different things. I think it's the right question. One of it would be the Fed deciding they don't have to go as fast or as hard, but that's probably off the table given, the inflation that's out there. But that would be a real elixir that would allow the markets to probably go a little bit further. The other thing would be that we end up being wrong about the earnings revisions, right? So far, earnings have been very resilient at the S&P level. We've seen some deterioration below the S&P level at the stock level. And if we're going to be wrong, it's going to be on earnings. It's not going to be because financial conditions loosen up again. It's going to be because earnings disappoint or don't disappoint as we're expecting as we go through the year.
Mike, good to see you. Thank you.
Thanks for having me. Mike
Wilson, Morgan Stanley. Guy Adami, I know you're not a betting man, but if you had to place a bet here on whether or not corporations surprise to the upside on earnings or they don't deliver, which way would you go?
I'd go the not deliver path, Melissa, if I had to place that bet, and for a myriad of different reasons, not least of which, costs. It's going to be very hard for them to pass a cost on, and that's going to hurt earnings without question. And I think we're just starting to see that now, but I think we're going to see it in earnest over the next couple of quarters. So I think the earnings revision is going to be lower. And 4,400, it's not like it's literally a stone's throw away, and we've been there in recent history. It's just how we get there is going to be interesting. So, look, clearly I think there's another flush to the downside. That's been wrong now for the last month or so. But there's still a lot of headwinds out there I think the market's taking into consideration.
I think it's interesting that Mike brought up is, one of the factors that might cause him to revisit his forecast being the Fed not going as hard or fast as the market is now pricing in. I mean, it's sort of a double-edged sword there. Yeah, it's great short-term for the markets, but it also means that the Fed may not be going hard on inflation, which could run rampant. And as Larry Lindsay said today on the exchange, that will bring us into a recession next quarter. I mean, as soon as then, Tim.
I think the Fed is not listening to, and by the way, this is a positive. I think the Fed is not going to listen to the market anytime soon. I think the Fed, and I think this Jerome Powell, who I believe is much more of a hawk in his roots than people understand, is really understanding how far offsides they are here. I think the pricing pressures that we're going to see both from commodities and the labor markets are 9 months out. As we've heard, we've talked about the European data around where Ukraine isn't even priced into their energy prices. So quickly, the fire and the ice that Mike talks about, he says, look, I think if anything, we've had a case where even some of those ice stocks in healthcare have had a very big run. I think you do have to stay in many of them. I still stay in United Healthcare, in Tenet Healthcare, in AbbVie. But I do think if you look at the market here, the rally we've had is not going to lead to another one of these big Aprils, which people know is the biggest up month of the year.
Just the question you asked Guy about, do you think we're going to see conservative down? I think that last week we saw RH and Lulu, two different, big stories. But I think that I'm with Guy. I think we're going to start to see more pessimistic, and that's self-fulfilling. Once you see a couple of competitors or a couple industries, why do you feel like you need to go out there and put out a huge number when you can be a little more conservative and not really get punished for it so much?